When these events unfold, the negative events, that ultimately, I don't care who became president, the income tax revenue for the government is going to be below its needed levels. It already is, I understand. Why? Because there's so many people that simply do this, don't file, and hope to God nobody calls on them. And maybe a year later, finally the IRS catches up to them. And then they get a payment plan. And the number of people who ask for payment plans now. As I drive around in my Toyota 4Runner and I turn on Sirius Radio, whether I'm listening to the Fox channel or the CNN channel, I hear all these ads, and about half of them are tax-related companies to help you with the IRS. I thought everything was great. Well, why is it half the ads or somebody will save you from the IRS? Somebody's having problems already. So if you dent that market, that stock market, and even though a guy made a nice chunk of money last year, but suddenly his perception come February, March, April of this year is,
You're watching Capital Cause, and my name is Danny, and today's guest is Michael Oliver. Michael, thank you so much for coming on, my friend.
Thank you, Danny.
All right, Michael, well, let's just dive right in. For you right now, I'm going to ask you this same question that I ask all my guests, which is, what is most topical for you? What is on your radar screen at the moment? We were talking about a number of things off camera regarding what your main asset of interest for the year of 2025 is. Go ahead and run us through what you're seeing out there.
Well, we see the ongoing trend in gold. Okay, now there had been, since 2015 low, it was $1,050, and now we're 2,800 plus. And so it's a nice move. And in fact, it's it's hard for people to believe because they're all focused on the stock market bubble in the U.S. But if you go back to 2015 low, gold is only slightly underperformed the S&P. In fact, over the last year, it's beat the S&P. Yet there's nobody pounding the table or screaming that on CNBC or Fox Business News. It's all the stock market. And yet gold has done quite well. And yet people are skeptical. That's fine. I like that. Keep it that way. Till later in the trend, then it gets excited. And that's when you make a lot of money, when the latecomers join. But then the area that we're most interested in, that I'm arguing is likely to happen, is that in this phase of the gold bull trend, and we're now 9 full years into it, okay, and there's been some other bull trends that have lasted this long, 2000 to 2011, 11-year bull trend went from $260 to 1920. Okay, a lot of it occurred in the last year, okay, which is quite typical with the gold bull moves. It's and silver as well, where you arm wrestle your way up and then you accelerate. And that's when the public suddenly says, gee, I want in, and they're motivated because of other factors. Maybe the breakage in the stock market, for example, causes money to flow. But when I look at the gold situation right now, most people involved in that market are very skeptical and nervous about silver and the miners, the gold and silver miners. Mm-hmm. And they think, these are dogs, And we even use the phrase, silver's a little wild dog on a leash of gold. If gold's going up, silver's going to go up too, believe me. Silver might have sharper corrections, but then if you examine it closely, it has sharper upturns, percent-wise. And it's held its own versus gold quite well on a percentage basis. Last month, for example, silver beat gold. Last 12 months, close of January 2024 to the close of January 2025, if you listed all the asset categories like gold miners, silver, gold, S&P, NASDAQ, T-bonds, etc., the greatest performer was GDX. It's mathematically true. Even though GDX is not out above its 2020 price highs, which was $45, we're pushing at 40 right now. Gold is, and yet on a percent basis, GDX has actually beat gold over the last year. Price to price, percent gain. Silver, gold, and then the stock market's way down there. And yet nobody notices that the monetary metals for a year now, and last month especially, are beating the pants off the stock market. And yet there's no cheering. I love that. Again, The public doesn't notice, especially over here. But the miners, historically, even though they've recently outperformed, especially over the last year, for example, are very, very cheap in relation to their historical relationship to an ounce of gold. They're very cheap in their relationship to the broad stock market. In fact, if you look at a spread chart, and the first one you can look at is the spread chart of the XAU index, which has been around since the 1980s. GDX, for example, the ETF, has only been around since 2006, I think. So we reference XAU, and it's pretty evenly weighted index, by the way. It's silver and gold miners, not just gold miners. And if you bought XAU at its bear market low in 2015, its low monthly close, I think, was 45. Right now it's 155. Okay. You do the percent gain from that bear low to the current price, beats gold handily from its bear low to its current price, even though gold is out above its 2020 highs yet in that period of time. But still, when you look at the spread relationship between the miners and those assets, gold and versus the stock, they're dirt cheap. You look at the spread chart and they're just laying on the floor. Oh, they're holding their own. They're actually gaining a bit over the last 9 years versus stock market and gold. But they're still dirt cheap historically. The spread chart is a measurement of price of one versus the price of another. So we divide the price, for example, of XAU index into the price of the S&P and express it as a percent. And as you can see back in the 1980s, 90s, 2000, it was way up there, 30, 35%. Then it collapsed off the page to that 2015 low. And since then it's laid in a horizontal range, but off that low. If you ever break out of the bottom of that range that we've been in for 9 years, which is, again, very cheap, and it's proven I'm not getting cheaper, okay? And you break out of that range, there is no resistance on that spread chart versus gold, or the resistance versus if it breaks out of a similar pattern on the S&P, massive percent gain potential of the miners versus gold and miners versus the stock market. Now, when you look at the gold spread versus XAU, you'll see that if you break the XAU out on a relative basis out of that basing pattern at the bottom of the page, breakout, you could triple that spread relationship just to bump the bottom end of that multi-decade range that prevailed from the 1980s, 90s into 2000. It's up around 17%. From the current spread level, that's a triple. What does that mean? It means in the next up leg in gold, probably a more accelerated leg than we've seen so far, the miners will take off relative to gold. The public will finally realize, gosh, gold miners. And it's such a tiny little sector that if you punch a hole in the stock market, the bubble, and already we're seeing a hole getting punched. Our estimate, we've broken one, the Sensex in India, which is also a bubble market. It broke last month. S&P's broken on its long-term momentum as of last month. The Nikkei is about to. The NASDAQ 100 is the one we're really watching. It's like 1% below today's price low. If you close a week out, we argue that's it. We're headed into a bear trend using quarterly momentum of NASDAQ, which is the leader index, NASDAQ 100. Once that occurs, money seeks other places to be. I mean, if you're an investor and you're hurting and you look around and you say, well, what's been working? You're a portfolio manager. You may have been skeptical of the stock market for various fundamental reasons that we all know, that we see on charts all the time about the earnings or the, et cetera, the relationships and all the fundamental things. Yet it hasn't broken down. So you've been skeptical, but you had to be long because you're competing with other portfolio managers who are long up to their eyeballs. And if you're not, you're an underperformer. Okay. But you're skeptical. As soon as you have enough poking by the stock market to provoke you into starting to exit some of that money, you ask your guy in the back office, your trading guy, so what's been doing well over the last year? And he flips up a chart and says gold. And actually the gold miners, they beat the market last year. In fact, they beat it for the last 9 years. Miners have. So the portfolio manager, whether he's a gold bug or not, is looking for those few places where he might move some money to a safer place, something that's proven itself. And that's when, if enough of that flow starts, doesn't take a lot, you can goose that little tiny sector off the page, the miners. And I think that's what's about to happen. And we base that on technical factors that we see, macro, long-term factors. So that's where I'm personally moving most of my position, less in gold and more into the miners, less in gold and more into silver, because silver has the same situation versus gold. That's where I think 2025 is going to look the best.
Fascinating stuff here, Michael. So multiple things here. You're alluding that we may have hit the highs of 2025 with respect to the S&P, correct?
Yeah, it's already broken. In fact, it broke what we say when we say quarterly momentum. That's a long-term measure of the momentum action of an asset. And what we do is we measure its price in relation to, oscillated in relation to a 3-quarter moving average, which adjusts every quarter. You know, the average goes up or down depending on the market. And we plot the monthly bars or the weekly bars of the S&P or the NASDAQ or whatever category in their relationship to that average, how much above, how much below, and we end up with an oscillator, not a price chart. And almost always before a trend change occurs on the price chart, where you can suddenly realize, my God, that's a top, momentum will have long ago told you that was the top. It will have broken structure first. And we've already broken it in the S&P, but we haven't broken it in the leader index, which is NASDAQ 100. And why do we call it the leader? Since 2009, the S&P has gone up a dozenfold. Since 2009, the NASDAQ 100, has gone up 9-fold. NASDAQ 100 has gone up about 18-fold, okay? More than double what the S&P did. It's the leader, just like it was in 2000 at the dot-com top. And if you recall back then, when the S&P went down 50%, 2000 to 2002, NASDAQ 100 went down 82%. Okay? So it led the downside as well. I think we're in the same position now. The only difference is this bubble is far bigger. It's accumulated far more years of upside, far more public money, especially in the latter phase, and therefore far more dangerous for the average guy. Not even people aren't in the market will be impacted by the in-the-street realities that get exposed when that stock market breaks, such as the data points that the Fed likes to look at that are always lagged to the stock market, by the way. At that point, they'll panic. And when the Fed panics, and gold knows this, what happens? Monetary policy goes berserk again, as berserk as possible, because this is the biggest bubble they will have ever had to deal with. And therefore, its data points are likely to be very dark. Money will go, the monetary expansion, the cheap money, et cetera, Fed balance sheet, they'll move. That money's not going back into the stock market. It never does save the stock market when the Fed does this. 2007, they started cutting rates 1 month before the high. Though Bernanke said there was no mortgage problem, right? Okay. Why did he cut rates? Obviously there was. Market still collapsed. They cut rates all the way down. 2000 to 2002, they cut rates all the way down. Market still collapsed. Where did the money go? 2 markets, T-bonds and gold. And
does your analysis extend out to silver miners as well?
Or absolutely. In fact, I'm sorry. Yeah, I think silver will not only beat gold, but also the silver miners will resurge against the gold miners on a percentage basis. So right now, my outright positions in miners, just without ETFs or anything of the sort, are silver miners. Okay. I also have double long ETF of GDX. I want to emphasize it. And so I'm going to shift more and more money out of what are cash bullion equivalents of gold into those two categories. And I think what happens over the next few weeks is likely to demonstrate that next shift in the monetary metals. So far it's been, 2 steps up, 1 step back for gold, 4 steps up for silver, 3 steps back for silver, then up again, far more exaggerated. We're about to reach a point, I think, where you go 8-10 steps up and then 1 step back. In other words, where the trend changes its dynamics. And I think in part that will be due to the puncturing of the bubble in the stock market.
Fascinating stuff here. And what of the rest of the commodity complex? And before we get into that, I just want to do a quick, plug to the sponsors of this video, ITM Trading. If you're interested in upping your gold and silver stack and really figuring out what really works with you, then schedule a free personalized strategy session. They'll work with you on your particular situation to really understand how you should allocate your gold and silver. So I have a link to that down below if you're interested, guys. It's totally free, so you have really nothing to lose in this regard, or you can just call the number as well at the bottom of the screen. Michael, what of the rest of the commodity complex, though? Is this a capital rotation event, as my good friends over at North Star Bad Charts like to say, in the sense that you will start to see a rotation of capital from growth into commodities, gold, silver, things of that nature? Do you agree with that?
Yeah, the last time in a big way that this happened was in the late 70s, as we know, as gold was headed in correction low in the summer of 76 to 1980. It went from $100 to $850. And during that time, a bit lagged, admittedly. About a year off that low, like in 1977, the commodity complex joined gold. Now, during that time, we were still in a wasteland for the stock market, meaning you could, in fact, go back to the mid-1970s and draw a line horizontal through 1982, and the S&P would oscillate either side of it. So you had 15 years or almost 20 years of wasteland. But during the mid to late 70s, monetary metals exploded, and then we had stagflation. How can you go up in quote, stagflation? And commodities exploded despite the global recession. Mm-hmm. So factor that into your thought process. If you think commodities can't go up in a global recession or depression, think twice. They're dirt cheap historically to themselves. Look at the Bloomberg Commodity Index. It made a low in 2020. About the same time, gold had already doubled from its 2015 low to its 2020 high. Had gone from 1,050 to 2,070. Okay. During that same time, commodities went down. They had already collapsed to 2015, but they continued to erode, so they weren't in sync with gold. Then in October of 2020, commodities got an electrode attached to them and they exploded. We put out a report that said commodity explosion coming. At about 70 on the Bloomberg, it went to 140 by early 2022. But even at 140, so that peaked basically around the time of the Ukraine-Russia war, by the way. So the war didn't cause the move had occurred already. But even at 140, if you look back at history, the Bloomberg was at 235, I think, in 2008. And it was like 170 something in 2011. So even this big surge to 140 was still cheap in relation to its historical prices. And then it dropped back down after that peak in 2022, had a correction, about a halfway pullback to its bare low, which had been 56, I think. And you oscillated for 2 years in price, either side of 100. It was like boring as hell, like no change year to year, month to month. It's like a 10-point range of nothing going on. Commodities were basing. This was pretty true with all the components, too. It wasn't just energy, wasn't just grains. They were all doing about the same thing. Copper, another example. Last month's action in the Bloomberg, by our metrics, argues we've begun to break out of that base. And at this point, we think commodities are about to join with gold, as opposed to not being with gold as they were between 2015 and 20. We think they're about to join. Like you mentioned, though, one of the factors of that could be the movement of assets. And when an asset manager looks around and says, too high, risk high, reward low, I want something that's low risk, high reward potential. And you look at commodities and frankly, they're cheap. $100 Bloomberg is no big deal. Right now we're trading 102, 103. We think it's starting its next major up leg, and I think it'll join gold. And when you look within the Bloomberg, in that last surge, oil was a leading participant, oil and natural gas, in that surge from 2020 to 2022. Everything went up too, but they were a leader. This time we suspect that one of the bigger leaders will be the foods, particularly the grains. We're talking percent gain now. And so we've already had breakouts on corn. I think beans are about to, and wheat is close. And so they're all basically in agreement with what we're seeing in the Bloomberg. So it's not just the index, it's actually its major subcomponents. So if I were a stock market investor only and didn't buy hard assets like grain futures or gold, and I only wanted to buy stocks, I would be buying gold and silver miners, but I'd also be buying ag-related stocks. There's an ETF called MOO, M-O-O, which contains a lot of companies involved in production of food commodities, grains, fertilizers, and things like that. That's one place I would be looking as a place to be over the next year. Despite an overall stock market likely decline, that sector, which is not really behaving like the stock market anyway, will likely go up.
Fascinating again. Do you see this weakness in the broad markets? Is there a sequence of events that we should be looking towards? Yes, the broad markets are weakening. They may have hit a high in regards to indices like the S&P and various other foreign indices, but on the way down, doesn't everything come down with it as well? Is it? You said that you're accumulating now. But do you anticipate seeing some downside once that haircut begins? Go ahead.
No. I think we've seen it. In fact, recently we've seen gold and silver. Gold hit 2,800 and then spent what? It dropped down to 2,540 of the day after Trump's election. Panic selling of gold, thinking Trump's going to solve the problems of the world, et cetera. That was the low, and now we're new highs. Okay, so it shrugged off the Trump event. But it went through a multi-month correction while the stock market was up there at its highs. Okay. And silver went through a sharper correction from $35 high down to the low 29s. Right now we're pushing up toward 33 again. So it already went through a process of correction while the stock market was still firm. So I don't think there's a linkage. Everybody has that burned in their memory, the October 2008 collapse in the stock market. And gold happened to collapse that month too. But at that point in time, gold had already had a massive move and was in need of a correction. And it was only a correction within the ongoing uptrend in gold. In fact, it was a buying opportunity. Once October was over of 2008, it exploded back to its highs. S&P did not. And gold was really in opposite sync to the stock market from 2000 through the 2011. So no, I'm not afraid of that issue because that was an isolated event, and I don't think it's going to happen again. I'm also not confident that we're going to have a stock market crash. I think we're going to have a major bear, but I could also see it unfolding in double-digit layers. Now, what's a crash? 29, 87. The COVID event, those were all 30 to 35% drops in a matter of a couple weeks. Mm-hmm. Not 10%, not 20% drops, 35%, couple weeks, bam. I see the events that are about to unfold if you trigger the NASDAQ, and our numbers are specified in our reports, you trigger the NASDAQ, the mama market, you could go down fairly sharply after that, but I don't necessarily see a crash type event. I could see something like 5 or 10%, then try to hold another 5 or 10%. And even that would be torturous and changing in the atmosphere, because if you think about it, whereas the average guy, let's say upper middle class or middle class, there's only one thing out there that he's been smiling about. It's not going to the grocery store and seeing the prices rise, et cetera, et cetera. It's not anything like that. It's just retirement account. His S&P reflective account. It went up 20% last year or so. So he's smiling. That's the only thing that keeps him happy. If you take that away from him in a matter of a few months, like 10, 20%, that alters people's perception of their future. Because then they don't have anything to smile about. And so that creates emotion. They have nothing else to look at that looks good. And if we're right about commodities, and I think we are, Trump is going to have a hell of a job restraining the upturn. Now, it's not his fault. This was going to happen anyway. These are macro trends spanning decades, these type of events. And they're usually caused by monetary excess that creates effects in various markets. But the commodities now look ready to go up again significantly. So he's going to have a problem keeping grocery store prices down. So it's going to look bad for him no matter what happens. And also, if the stock market breaks, then the people who thought the Trump victory was good, it's not breaking because of Trump. It's breaking because of macro events that have been underway for decades that are unfolding. But anyway, if you take that away from the average investor, his retirement account gains, then that emotional factor comes into markets, which isn't there right now. Right now, there's a pretty happy factor. Factor that in to the environment out there. When everybody's disappointed and uncertain, what the hell's working? Well, there'll be one or two things working, and gold is primarily it, gold and related.
We've talked about this before, Michael, but this idea of removing the income tax, will this provide relief for the average consumer? Well, granted, 50% of people don't even pay income tax in America, but for the other 50% that do, will this provide some tailwind for on the demand side?
We've been saying this for over a year, that when these events unfold, the negative events, that ultimately, I don't care who became president, the income tax revenue for the government is going to be below its needed levels. It already is, I understand. Why? Because there's so many people that simply do this, don't file, and hope to God nobody calls on them. And maybe a year later, finally, the IRS catches up to them. And then they get a payment plan. And the number of people who ask for payment plans now. As I drive around in my Toyota 4Runner and I turn on Sirius Radio, whether I'm listening to the Fox channel or the CNN channel, I hear all these ads, and about half of them are tax-related companies to help you with the IRS. I thought everything was great. Well, why is it half the ads or somebody will save you from the IRS? Somebody's having problems already. So if you dent that market, that stock market, and even though a guy made a nice chunk of money last year, but suddenly his perception come February, March, April of this year is, I can't afford to pay this. My income's dropping. My retirement account just collapsed 20%. I got to do a payment plan, or I'm not going to file and hope to God nobody comes after me. That it's inefficient means for the government to collect the money. And therefore, regardless of whether they like income tax or don't, like most Republicans don't like it anyway, and Trump has already said he'd love to get rid of it, they'll have an excuse to get rid of it. Because in this case with Trump, if he has a weakening economy, he can provide a smile. It'll be temporary because other factors will come into play on a lot of faces by saying, okay, income tax is over. Now, ultimately, they'll have to replace it with other sources of revenue, like a national sales tax has been proposed. So that'll show up, but in little pieces here and there. And, of course, in his tariffs. And those ultimately, you'll feel those as well. But, yeah, I think income taxes will be abolished when these events unfold. And the stock market is a key in that because it will bring the data points down and, therefore, an excuse to end the income tax system, because it's not a viable source of revenue anyway for the government. So I think, that'll happen, but will that change reality? Nah. It'll just reflect the negative reality that's going on. And temporarily, it'll put nice smiles on faces.
Won't more people have more money to invest in the markets then, if they get to keep more of their money? If
their commodity prices are going up, 10, 20, 30, 40%, because, remember, the last move in the Bloomberg was a doubling. We put out a buy signal. It was 70 and went to 140 in a matter of a year and a half. Yeah, a year and a half. It corrected 50% way back. But, if you double again, that wave was a year and a half, doubled commodity prices. And remember, commodity prices are still cheap. So you turn up one more time, especially if you break the stock market, that causes asset flow to go somewhere else. And asset managers have various means of buying commodity and commodity-related assets. And they perceive them as less risk because they've not been going through the roof. and they look like they're basing. And when they start to uptick while the market goes down, that'll smack them in the face, and they'll start to move more and more money over into commodity-related assets and or maybe commodities themselves in various ETF forms. So I think that comes, yeah, so if your income tax collapses, that's great, but you're going to have more sales tax, which is incremental and, here, there, and everywhere. So it doesn't hit you in the face. And then tariffs will no doubt add something, but also a rise in commodity prices. And also the other probability, unemployment's going to go up big. So your income's not going to be the same. You may not even have a job. Remember 2008 and 9, people that had nothing to do with the mortgage situation lost their jobs. I had many friends and associates who I knew back when I was at Hutton in the 1970s who moved on into Wall Street. I left the city and went and started research in 92, MSA. But a lot of them went into major brokerage firms. And I just saw The Big Short again last night. I love watching that movie. And I remember the scene where all the Bear Stearns people just walking out the door, even the people who had nothing to do with the mortgage situation or the bets that Bear Stearns had placed that blew up in their face. And I have a good friend who used to be at Hutton, the commodity division, became head of the commodity division at Bear Stearns. The poor guy had to walk out the door. It's that kind of reality can hit you. So yeah, income tax goes away, but maybe your job does, or maybe you,
Right.
you get the point. So it'll be offset by other things. In fact, it's those other negative things that will help cause the income tax to be erased.
Yeah, the way I see it, income tax is the removal of the income tax is inflationary. Many people will say tariffs are also inflationary, but if you really think about it, don't tariffs provide a deflationary measure in the sense that they lower the demand side? So if prices go way up on certain products that come from overseas and tariff countries, won't demand just simply come down, and you'd see much less money
or it'll
velocity
shift to other manufacturers of those products that are domestic. Again, when I use the word inflation, now most people use it the way you did, which means prices of things going up. In particular, they don't mind it. The Fed doesn't mind it when the stock market goes up, and yet that's an inflation aspect. Something printed those things higher. Believe me, you look at an M2 chart, it looks like an S&P chart. Or you look at a Fed funds rate chart. Go back 50 years and look at what happened since 2008 and 9. Zero rates for 10 to 15 years, and even the recent rise in rates was still low compared to any other period of time. So we had free money. That's inflation. M2 chart is inflation. And it doesn't always go into commodities. It shifts. There have been periods of time where stocks were a wasteland, like the late 70s to early 80s. Money didn't go there. Money supply went up. It went into commodities. So it's a matter of rotation. And so if commodities go up, that's not really inflation. That's just a reflection that the inflationary expansion in money, cheapness of credit, went somewhere else than where it went before. Instead of stocks, it goes into cheap commodities. Instead of stocks, it goes into monetary metals. The real inflation is an M2 chart. And over the last, go back to the 1950s, every 10 years, M2 basically goes up 90, almost doubles every decade. It means the degradation of your paper money unit goes down 50% every decade because it doubled in quantity. So when I was a kid, a loaf of bread was 20 cents. Okay, well, I guess we have a wheat shortage, right? No, we have a monetary degradation. And this is true with all assets. But it doesn't always flow evenly into commodities to reflect the inflation. It flows into stocks sometimes and reflects the inflation. I think we're about to rotate.
Interesting. I have a question from my audience on Substack. This is from David Cooper. His question is, why isn't platinum working out as a good way to store wealth? Platinum was way higher than gold in the 90s. Whatever happened to rhodium and palladium?
Yeah.
They went way up a few years ago, but now I don't think they're even available anymore from the bullion dealers.
Some of them do sell it, but platinum ceased to be linked to gold years ago. And if you look at a Bloomberg Commodity Index monthly price chart, go back 10 years or so or more, and an overlay a platinum chart, that's what platinum reflects. Platinum is a almost perfect reflection of the Bloomberg Commodity Index. It doesn't reflect gold anymore. It is a commodity. Yes, it's a, quote, precious metal. And that's why we don't use the word precious metal when we talk about silver and gold. We call them monetary metals. They're distinct from palladium and platinum. They're precious, but they're not monetary. And so that is the difference. Now, right now, I do think platinum is going to sort of join gold because I think it will participate with the overall Bloomberg upturn. Platinum will be a player. And who knows, maybe it'll be a strong player. But it's not because gold's going up. It's because it's a commodity and it's going up with all the other commodities. And even palladium, which had its orgy a couple of years ago and then collapsed, it looks ready to reassert itself in some way. So, but platinum is a reflection of commodity prices, not of gold.
Interesting. Have you been keeping up with this story about the LBMA being emptied out of gold and deliveries taking now 4 to 8 weeks to complete? What's your, do you have any additional insights on that?
I have no insights whatsoever. And, I assume it's true or partly true or whatever. I ignore that stuff. Okay. I hate it when things like that come out. Ultimately they come out, especially they come out near the end of a bull trend when you're really going vertical. And then you realize the reason for it. Like I can see silver exploding to $200 an ounce, for example. It wouldn't shock me just to get back to a normal parity to gold. If gold went to 8,000, for example, that's merely a reflection of the bull trend of 2000 to 2011, by the way, eightfold move. And then also the 76 low to the 1980 high, eightfold move. You do another eightfold, goes to 8,000. Oh, third time in 50 years it's done that. If silver matched gold in that trend and got to its normal spread relationship, 2.5%, the price of gold. It's been there 20 of the last 50 years, been at that level. Right now we're 1.15%, the price of gold. So if silver spread merely went to 2.5, you do 2% of $8,000 gold, okay? Silver's off the page, okay? So anyway, I'm sorry, I may have gotten off the subject. What's your question again?
No, what do you make of this story from the?
The story, yeah, that probably has validity, but then again, I can't measure that. It's not technically measurable. I measure the price momentum action of the underlying market. So yeah, we look at gold price, XAU price, stuff like that, silver, but we're really looking at the momentum structures, meaning annual momentum of gold. How does it look versus its 3-year average when you oscillate it? Quarterly momentum, monthly momentum, etc. All those factors are positive, and they're not near, especially annual momentum is not even near something that it might break and indicate bear trend. All the other major upturns and downturns in gold for the last 5 decades have been definable via annual momentum. Whereas if you plotted the annual momentum chart, you would say, oh God, there's a trend line from hell. You don't want to break it. So you broke it in late 2011. Price didn't break anything, but gold said, that's it, I'm over. Same thing happened in 2015. As soon as you made your low, 2 months off that low, you broke out over an annual momentum base. Since then, nothing has developed on momentum that says top. Therefore, you're still in the trend. So that's what we look at. And yes, there's factors like this that you're talking about, the shortage of available gold or silver, that will impact those markets. And they'll become emergencies. But ultimately, there's a bigger driver. And it's not just those specifics. It's the ongoing degradation of paper money. And whenever you get a situation where certain assets are in jeopardy, particularly government debt assets, which is now the issue, especially in the US, we know there's a monster out there. And it's going to happen, and probably soon, in terms of what the hell are we going to do for that debt relationship. No longer mortgage issues. Now it's the government debt. And we have a stock market bubble. Those are the kind of factors that provoke the central banks into doing what they were invented for. Defend the institutions we want you to defend. Government, banks related to government, etc. And that's what they will do. They'll put the pedal to the floor, despite their recent academic meanderings about how well we're in this balance point. We're going to be with two mandates here. Once we shift into the dark economy, I don't care. I guarantee you that the unemployment issue is not going to look good anymore. It doesn't even look good now, but they won't have the excuse anymore. So even though commodity prices will be going up, that's going to be a predicament for them. When they have the data points go dark, employment, for example, that's when they'll push the pedal to the floor, and so will their associate banks, Bank of Japan, ECB, et cetera. So it'll be global reinflation again in terms of acceleration of the decay in the value of the money units. That's what drives gold.
Fascinating stuff as always here, Michael. Thank you so much for your time. Anything else you want to talk about before we sign off here?
No, not really. If you want to check out our work, go to olivermsa.com. Tool around there, we discuss our methodology. You see a lot of older reports, call it stock market tops and bottoms over the decades, and a lot of other major market calls. And we're different. We don't look, the price charts are interesting and sometimes they're helpful, but we're totally momentum-based, structural momentum-based. And you'll understand that when you go to our site. But I think 2025, and I thought 2024 late might be, it wasn't. So I was wrong in that regard, might be quite dynamic. Instead, the stock market stayed constipated up near its highs, so it wasn't dynamic. And gold and silver had this muddling around. So I was wrong on that, but I think the dynamics are about to unleash. And I think 2025 will be quite violent year in terms of basically all markets.
I see. Well, thank you so much for coming on, Michael. We'll have the links to all of your socials down below as well as your website. So be sure to check it out, guys, if you're interested. Also, check out our sponsor, ITM Trading. We do have a link down below to schedule a free one-on-one session, strategy session that enables you to figure out what works for you. What should you be invested in? Should it be more gold? Should it be more silver? Schedule a one-on-one call and figure it out. And finally, if you enjoyed this video and you got value out of it, hit that like and subscribe and type "Go Michael Go" in the comment section. If you disagreed with anything that we talked about, be sure to let me know. I do read the comments. Really interested to get your take here, guys. And then finally, check us out on Substack, capitalcosm.substack.com, where you can get early access and ad-free versions of all of my interviews, as well as uncensored versions for the interviews that require it. And so with all that said, Michael, thank you so much for coming on. And guys, thank you so much for watching. And I'll catch you in the next episode. Bye, y'all.